Well, if we really had no inflation, gold would not be doing this. Silver would not be doing this. So these are real world market indicators that there's a problem here, and that is inflation. These are inflation hedges. These precious metals are very sensitive to inflation expectation. People expect more inflation, they buy more gold and silver. So that's people voting with their feet, right? They're walking away from dollars and they're putting their money where my mouth is, and they're buying gold and silver. So this shows you that what Trump is trying to sell you and what the Federal Reserve is trying to con you into believing are...
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Today at about 3,760. It sold off towards the end of the day. It was above 3780 going into the last hour. We kind of sold off at the back end of the day. But, the absolute high, though, was set on Tuesday. So gold hit its all-time record high earlier in the week on Tuesday. It didn't quite get up there today. It almost hit 3,800. It came less than $10, maybe even less than $5 from 3,800. Silver, however, just kept on chugging along, making new highs pretty much every day of the week. It closed this week above $46. And it traded intraday a new high going back for about, 14 years or so. It got to 46.50 and change on the day. Here are the numbers so far on gold and silver. Gold up about 0.5% on the day, 2.2% on the week, 9% so far in September, and 43% this year. Not for a year, but so far in 2025. Silver doing even better, up about 2% today, 8% on the week, 8% in 1 week, 17% in the month of September, and 59% so far for the year. 59%. Now, of course, I don't talk as much about the other precious metals, platinum and palladium, although I have been talking about platinum a little bit more over the past year. In fact, I came out on this podcast, if you recall, when gold was above 3,000 and platinum was below 1,000, and I made a strong pitch that my listeners go to Schiff Gold and buy platinum, because I thought it was ridiculous that you could buy 3 ounces of platinum with a single ounce of gold. Platinum was up 3.3% today. It's up 12% this week, 19% on the month, and 74% year to date. 74. Palladium also not quite as good, but inching out gold. Palladium up 44% on the year. Now, these are not normal gains. And it's not like these gains are happening, at least for gold, at depressed levels, because we started the year at record highs. And now we're just adding to those record highs. Yes, I think platinum and silver were depressed in relation to gold, not necessarily in relation to their own history. Although silver, at $30 or wherever it was at the beginning of the year, was still cheap compared to where it had been in the past, but it wasn't anywhere near a record. Gold was at a record, and now it keeps setting new records. But this would not be happening if inflation were well contained. Right? If we really were headed back to 2% in 2 years, like the Fed claims, if inflation hadn't been beaten into submission the way Donald Trump claims, every time he gives a speech now, whether it's at the UN or whether it's at Charlie Kirk's funeral, he talks about how inflation is dead and buried, right? How we've got the hottest economy in the world, it's the greatest economy in the world, and we've got no inflation. Well, if we really had no inflation, gold would not be doing this. Silver would not be doing this. So these are real world market indicators that there's a problem here, right? And that is inflation. These are inflation hedges. These precious metals are very sensitive to inflation expectations. People expect more inflation, they buy more gold and silver. So that's people voting with their feet, right? They're walking away from dollars and they're putting their money where my mouth is, and they're buying gold and silver. So this shows you that what Trump is trying to sell you and what the Federal Reserve is trying to con you into believing are not true. We got the personal income and spending numbers for August, and they pretty much came out right in line with expectations. So I don't know that there was any movement in the market that was necessarily affected by it. I mean, maybe the market went up because it wasn't worse than expected, right? Because everybody's always bracing for the inflation news to be worse than expected. But even though it was as expected, it's still bad, right? Personal income was up 0.4 on the month, and spending was up 0.6, which was actually a little hotter than expected on the income and spending side. But on the price stuff, right? The PCE, personal consumption expenditure. Now, this is the Fed's favorite index, right? And I think it's their favorite because it's the lowest, right? But the PCE on the month was up 0.3, which was expected. But that's worse than the prior month, which was 0.2. Year over year, up 2.7%. The rear view mirror was up 2.6. Now, yes, everybody expected it to go up to 2.7, but it went up. It's not going down. Why is the Fed cutting? Its favorite inflation measure is moving further above its 2% target. So why are they cutting rates? Why are they saying they're going to have more rate cuts? And it's worse when you look at the core, because apparently the core is the one they think is the most important. And the core was up 0.2, which was a little bit less than 0.3 from the prior month. But year over year, the core is up 2.9, the exact same as the month before. 2.9, it's almost 3. You're 50% above your target. Why the hell are you cutting rates? You know, I was listening to this discussion on television today, and people were acknowledging, they were saying, well, you know, we don't really need these rate cuts, right? Because we have this strong economy, and we got low unemployment, and we got a record stock market. So we don't really need the rate cuts. Well, we only need them if you want to prevent the stock market from crashing, if you want to prevent the economy from imploding, because the only reason it's not is because these rate cuts are coming. So you may not think we need them. It's only because we're getting them that the stock market is at a record. You can't say, oh, look, we don't have to cut rates because the market's at a record high. If we weren't cutting rates, it wouldn't be. In fact, the Fed should be hiking rates. Shouldn't be. Not only should it not be cutting rates, it should be hiking rates. And then the market would crash, right? So with the economy, in fact, the economy is already weak. When they keep talking about the low unemployment number, that's all BS. Unemployment is high. The numbers aren't accurate. That's the problem. But even some of the numbers, like the U6 number, at almost 8% or 8.1 or whatever, I think it's over 8%. It's high unemployment.
Peter Schiff argues that Wall Street has finally admitted what gold bugs have been saying for years. Inflation isn't going back to 2%, and bonds are a terrible hedge when inflation runs hot. Bonds, he notes, get crushed as purchasing power erodes, while gold has always acted as protection. For decades, recommending gold made you an outlier among big firms. That's no longer the case. Morgan Stanley has now openly told its clients to buy gold, signaling a major shift in institutional thinking. The implications are huge. If firms start advising clients to cut their bond allocations, say from 40% down to 20%, that means an enormous amount of bonds, including treasuries, will hit the market. And this comes at a time when the US government is already struggling to sell record levels of new debt. The flip side is that much of that capital is being reallocated into gold and mining stocks, creating powerful new demand flows. Schiff emphasizes that this isn't some minor adjustment. Wall Street operates like a herd. Nobody wanted to be first to recommend gold because it carried reputational risk if it lagged. But once a giant like Morgan Stanley makes the call, others will follow. As long as gold prices keep climbing, no advisor can afford to sit on the sidelines. That dynamic builds on itself, fueling even stronger gains. Let's get back to the interview.
Morgan Stanley came out and tweaked the 60-40 portfolio. Now, this is a Wall Street, bellwether portfolio. 60% stocks, 40% bonds, right? I mean, that's it. That's the portfolio. They tweak it a little bit. If you're really young, they might say, look, go 80% stocks and go 20% bonds. And if you're older, maybe go 60% bonds, 40% stocks, right? They tweak it depending on where you are, towards your retirement goals. But that's been the portfolio ever since I've been in this business. I got my license in 1987, coincidentally, the year the stock market crashed. That's when I became a stockbroker, the year the stock market crashed. So I didn't really enter the industry at the best time. Although in hindsight, it was a great time to buy, but it was, a difficult time because a lot of stockbrokers, were waiting tables, right? They lost their jobs because of the 87 stock market crash. But that's when I got into the business. But ever since then, it's been 60-40, right? Morgan Stanley said, you know what? We need to split that 40% that was in bonds 50-50 with gold. So Morgan Stanley came out and said our portfolio is 60-20-20. 60% stocks, 20% bonds, and 20% gold. Unbelievable. Now, it's about time. And the reason that Morgan Stanley is doing this is they're saying that we need an inflation hedge. And since stocks can also be viewed as an inflation hedge, although not all stocks are the same in that respect, but bonds are clearly the biggest victims of inflation, right? If you own bonds, inflation kills you. There is no hedge. And so Morgan Stanley said, look, we're going to have high inflation. Forget about 2%. That's old news. That's never happening again. And we're going to have high inflation. That's obvious. And so our clients need to hedge their bonds. So they need to buy gold. This is big. Not only is this a sell signal for bonds, because if you're a Morgan Stanley client and you got 40% of your portfolio in bonds and your advisor says, well, you got to go down to 20%, how do you do that? You got to sell half your bonds, right? It's a sell signal on bonds. A lot of those bonds are treasuries. So you have brokerage firms telling their clients to sell treasuries when the U.S. government has a record amount of treasuries that it needs to sell, right? Houston, we got a big problem here. But all the money coming out of bonds is going into gold. Now, again, the first time in my career as a stockbroker, major firms are recommending gold. Now, of course, I've been recommending gold the whole time. When gold was under $300 and I got my stockbroker license, I would tell people to buy gold, right? I was, the odd man out. Now, I'm still kind of the odd man, but I've got some company because it's just starting. Right? This trend is going to envelop all of Wall Street, right? It's like a herd, right? People are afraid to go out on a limb, right? Nobody wants to be the first one to buy gold because then if it goes down, you look like a fool. Hey, why'd you buy that? Why'd you put my money in that rock? Why'd you buy these gold stocks, right? You're fired, right? People are afraid, right? But once somebody else does it and it works, and then somebody else does it and it works, now you got to do it. Because now, if gold goes up, and it will go up, and the mining stocks go up, and you don't own them, now your clients are going to say, hey, why didn't you have me in any gold? Why didn't you have me in any gold stocks? You're fired, right? So now the pressure is